You guys, we'll kick off shortly here. Looks like we still have some people trickling in. Grab yourself a comfy seat. Spark up a joint if you're so inclined. Okay, it's 4:03. It's August 2nd, 2022. It's kind of hard to believe it's August already. This year seems to be flying faster than most. Or maybe it's just the fact that we work in crypto and things always move at warp speed, but still kind of crazy to ponder that. So yeah, I hope everybody's doing well today. I had a cool weekend. Celebrated a birthday with some awesome friends. I shared this in general earlier, but I want to post this again. My wife got me this cake created for my birthday, and it's highly relevant to ShapeShift, I think. Oh, Carlos, I see you in the chat. Yeah, you're going to be going up after the first few items here. So I'll bring you up on stage when you guys are ready to rock. So anyway, check out this cake. There's a lot going on here, but one interesting thing is, like, we're kind of looking at this fox, and you might initially think that the fox looks sort of horrified to see this violence, which kind of makes sense because, you know, here at ShapeShift, we're all about non-coercion and voluntary association, and we abhor violence, especially violence where governments have a monopoly on that violence. But once you think about it a little bit more, it seems to me this fox is actually cheering on the bear getting the shit kicked out of it, because that fox knows that we're going to survive this bear market and emerge stronger than ever. But yeah, awesome cake. So the other thing is, you know, specifically, this is a nice Ethereum unicorn. There's a lot happening right now around the narrative with Ethereum as the merge gets closer. It's looking highly probable that the merge will actually happen in September. That's kind of the best estimate based on the various test nets and whatnot. Of course, there's no guarantee right now, but it's becoming more probable. So you're seeing a lot of jockeying around the narrative. There's a lot of different parties that want the merge to fail. These include, of course, Bitcoin maxis, also narrow-minded proponents of, like, alt layer ones would love to see this go down in flames. And of course, current Ethereum miners, many of those also really have a vested interest in keeping the proof of work chain alive. So you've seen some signaling around that, like I think Antmain was signaling that they're going to continue to, or they're going to try to perpetuate a proof of work ETH sort of thing. Of course, then you have, like, Ethereum Classic doing well because that's an existing proof of work chain. That's an alternative. But I think you're going to see a lot of attempts to kind of talk about that narrative. And the important thing is that the merge actually happens and it goes off relatively smoothly. There's no guarantees. So this is the crazy part, you know. What does that mean for ShapeShift? I mean, obviously, ShapeShift will continue to exist on the merge chain, and, you know, there's no intent to be active on the quote old chain that will be on proof of work. But this is an area that's kind of potentially fraught with pitfalls. At centralized ShapeShift, we used to have a saying of testnet, schmestnet, because when you have economic incentives built into these things, as you do with crypto, you can never fully model things out in a testnet because there aren't those economic incentives. These testnet tokens don't have value. So we have a situation where, despite all the testnets and the merge going smoothly, it's hard to really say what will happen until they pull the lever and move the hamster from the proof of work wheel over to the proof of stake wheel. But it's going to be interesting to see either way. I'm excited as somebody who's been watching this for a long time. And once that happens, it's going to remove a lot of ambiguity around ETH. The energy concerns will go away. You see that a lot from critics of Ethereum. And then the focus can be on other important stuff like scaling. Thanks, GK, for the Zoom link. I will not be needing it. Possibly our presenter will. So yeah, speaking of our agenda for today, I'm just going to give a quick update on a runway, as well as a rundown on our Rari loans. The TLDR on those is things are looking good. We also have a special guest in the audience today. We have representatives from Fringe Finance, which is a lending protocol for longer tail assets, such as Fox. And then Pasta Ghost will be joining us to talk about some general thoughts around our budget and runway, and specifically around leveraging Fox to optimize both our, say, productivity, our community contributors, and our runway. So looking forward to that as well. So let's, if you're in the stage chat, just bump up there. You can see the link to the runway projections. Open that up. So here's where we are currently. This is updated as of today. We have 3.95 stables, roughly. One caveat here is there is a relatively small portion of that still needs to be distributed via colony, so marginally less, perhaps around like 35 to 50K less than that. Thanks Darwin for pointing out that fact just before the call. In any case, it doesn't make a big material difference to the calculations here. So currently we're at about a full year of runway, and this is really nice to see because a few months ago we were at much less. One of the important caveats I've mentioned whenever I talk about this, which is every week now because it's really important, is this assumes a worst case scenario where I'm not factoring in any revenue nor any income via like our Olympus USDC bonds. On the first point with revenue, it's been, I think, a pretty good idea to not be factoring that in, because revenue is in fact down a lot. For July, I believe it was just 25K for the month. The lion's share of that coming from our wonderful collaboration with the fine folks over at our validator partners there. We have, and that specifically that was the Cosmos validator. So thanks Marley and Scott for running those. But again, this is way down from the bull market peak, which is something like over 300K a month. But in terms of our Olympus bonds, that things are looking much better. I think owing to the increased price of Fox from its relative lows, we're currently netting just under 10K a day on those loans. So if you take the average of the past week, we're getting about 270K of USDC by selling the Fox. So that's a big deal, because as you can see from this monthly budget, even if at these relatively lower levels of USDC income, previously our bond sales were much higher. We're unloading a lot more Fox indirectly on the market there. But 200K accounts for a big chunk of our monthly expenses. And the important thing right now is it's also paying down a substantial proportion of our bonds, which I'll get to next. So this is kind of where we're at. I think this is a very good place to be, given that these our primary expense other than our monthly budget is getting winnowed down. Also, the difficult decisions made by workstream leaders to reduce our budget from closer to like 550K a month really has made a difference here. So that's kind of where we're at. And next, let's take a look at the Rari loan analysis, also posted in the stage chat. So this analysis was prompted by some recent discussions about, kind of triggered by like the request from the TMDC for a new allocation of Fox. Every time the TMDC wants an allocation, of course, it has to go for get governance approval for that. To not do that would undermine the whole idea of decentralization. So anytime, the TMDC exists because the community approves of its existence and its funding. But relative to those conversations, there was an interesting point made by Mr. PTT. Always has some great insights and thoughts, but he was curious. He's like, what about an analysis of the current loans, particularly with kind of an eye towards like, what would it look like if we paid off these loans now versus really paying them on a more gradual basis. So to put this all in context right now, the TMDC is currently paying $50,000 a week via those Olympus bonds, funded 100% by those Olympus bonds, in order to A, pay off the interest we're accruing, and then B, actually eat into the principal. So this is making a big difference, as we'll see. The APR on these loans, especially on pool 7, which is where the largest chunk is, about 755K, can be quite pernicious, quite a bit of a motherfucker when it gets high. I mean, it's gotten as high as like, over 75%. The really cool thing is right now it's much, much lower. We've paid down the principal, and also just by virtue of the other participants in the loan or in the pool, the APR is more like 12%. So that's been really good to see. So basically, and I won't dwell on this too much because I posted the analysis more thoroughly in the public tokenomics chat a few days ago, but I just wanted to cover some of the takeaways. So, the base case where we only pay off the loan or the interest that's accumulating, I took a conservative approach here and said, well, let's say the APR kind of reverts to the mean. It goes back up to 50%. Again, that's a lot higher than where it is right now, but historically, that's kind of where it's been. So I wanted to take that as sort of the base case. If we pay everything off right now, just pay the whole thing off and we don't have the loans anymore, we're left with just under 3 million of stables. And then our budget runs out anywhere between like May and June, depending on what the interest rate is. So, we'd be sacrificing 1 to 2 months of runway by doing that. Of course, the loans would be gone. If we instead choose to just pay off pay the interest every month, then we're looking at that, that case of our current runway projections of going until July. So we can also model things like, well, what if we're only able to pay 100K a month and the APR is at 50%? What if the APR spikes up to 100%? Assuming things stay as they are right now, we're looking at about, we would be paying off, let's see, where's the nice takeaways here? If our current payment regime continues, that's 200K a month, and the pool 7 APR averages 50%, we'll wind up paying about $86,000 in interest before the loan is paid off in January. It would be more like 195K if the APR spiked up to 100. Again, right now it's only at 12. So this already is assuming kind of a worst case than we see it in current conditions, but it's a conservative modeling. The time horizon stretches out an extra 4 months if we're only paying 100K a month. I did want to consider a scenario where, even though right now we kind of have a bounce off the relative lows in crypto, what if Fox, resumes this downtrend, and then we don't have as much income in stables from the bond sale? In that case, things would really get pushed out a decent amount over a quarter, and then kind of the worst case scenario, or I should call it worser case, because there's always a worst case. But let's say we're only paying 100K and the APR balloons up to 100%. In that case, costs really balloon, and the interest would cost us just over $500,000, and we wouldn't pay off these loans basically before a year. So what does this all mean? Or what takeaways here? I think this basically is a validation of our current strategy of just taking these earnings from the bond sale and applying those towards the loans at a rate of 50K a week. So as we've seen, paying everything off right now would really reduce our runway. A point that John has articulated really well in recent weeks is doing that would eliminate the optionality around having that USDC, whereas we maintain that optionality for a relatively small cost at current or even at 50% APR. So I think this is a validation of the strategy. Of course, this is not my call. This is up to the TMDC. But I think this is generally a good approach. But just know that we're watching these loans like a hawk. Of course, there's also always a liquidation risk as well. Our liquidation points, I believe, are just under a cent now because we paid down the principal so much. And one other thing to keep in mind, and this is a point driven home by the bridge hack over the weekend. Of course, this is not a bridge, but smart contracts come with some non-zero possibility they can get hacked. So, of course, we always run the risk of something happening. Luckily, borrowing's turned off right now, and the functionality of Rari seems to be working fine right now. So that's kind of the big picture. Let's see, never was. I would caution complacency. The budget runs out if we, as a DAO, don't do any other austerity measures. Don't get complacent with a runway of a year. Yeah, absolutely. I mean, that's a wonderful point. It's not like having a year of runway is a relatively good situation, and but it's not something we would want to rest our laurels on for sure. We want to be very proactive about continuing to control costs, as well as finding other ways to maybe even optimize our budget more. I think Pasta Ghost will be speaking to that towards the end of this call. So that's kind of the big picture here. And hey, what do you know? We're right on time. It's almost 4:20. And I think we're ready for our guest speakers here. So let me get Mr. Carlos up on stage. This is going to be Fringe Finance. Before we start in with that, did anybody have any final points on or questions or thoughts around all that initial stuff? Happy 420 to you as well, Hunt. Smoke them if you got them. Okay, Carlos, I sent you an invite. I think, let's see. I think he might be reconnecting. Is anybody else from Fringe joining us right now? If you could just raise your hand in the audience. Potentially that might be Brian or Constantine. Okay, I think, yeah, DeFi Boy. I'm not aware that DeFi Boy is with Fringe. Bring you guys up anyway. Hello, DeFi Boy. Welcome to the stage.
Hello, Kent. Hey, yes, I am with Fringe. Thanks for welcoming me up. I'm just trying to find out what's happening with Carlos there.
Yeah, it sounds like he had some AV issues. I'm glad you made it up safely. How's it going today?
It's going well. Yeah, it's early in the morning here. It's about 8:30.
Yeah, thanks for handling the time zone difference with us.
No, that's easy, man. It's all over the shop with the DeFi world because there's people everywhere interested in all of this stuff, and it's an absolute pleasure to talk to everyone.
Absolutely. Let's see here. Assuming Carlos, I imagine he's working on the issue right now. DeFi Boy, would you mind just kind of giving us, starting by giving us an overview, kind of a 30,000 foot view of what Fringe Finance is?
Yes. Now, may I ask for you to invite Distbit up because he's part of our team and he'll have a few things to, he keeps me honest. He'll correct me on a couple of things. But I'll tell you about our project.
So sorry to interject. So yes, we do have an invite out to Distbit. He just needs to manually jump up on stage here.
Right. Okay. Got it. Fringe Finance, in essence, is a lending platform. We're a non-custodial lending platform. So it entails over-collateralized loans and specifically stablecoin loans collateralized by long-tail assets. So our model is familiar and it's sound. And given it's non-custodial and over-collateralized, all of that, it does not permit any of the trusted shenanigans that have happened in some of the dumpster fires of late. So I think that's really important that we just explain that our engineering and our And the concept that underlies our platform is as sound as we can possibly make it. That's really what we're about, because there are other lending platforms out there, but they primarily support the more popular and large cap tokens. But our difference, and this is where it comes to fringe finance, is we support lending against long tail assets. Our vision is to be the place to go for holders of long tail assets. No one else in the market really does this well or with our focus. And we've got special engineering and lending parameter settings that is tailored for long tail assets. So we're in the business of giving additional utility to holders of those long tail assets, because they hold those assets because they're passionate about their project and they believe in the token's upside potential. And if they want to exercise their capital, instead of requiring them to dispose of their asset so that they can get something more in demand to pay for expenses, such as stablecoins, they need to sell their tokens. We give those token holders an option here. We believe in this because there's a lot of capital tied up in those assets, and the holders don't have many options to deploy their capital elsewhere while they wait for their tokens upside. So that's really what we're about. And you know, I'm happy to field any questions, but and we can talk soon about the offering and the proposal that we have for the ShapeShift DAO.
Yeah, kind of going back to the original, kind of what you were saying at the beginning about the virtue of having transparent and over collateralized loans. I think like we've seen such a rousing validation of this with the big sell off that happened recently in crypto, where you had these centralized lenders just utterly melt down because of the very same lack of transparency that we've seen so many times in TradFi. Meanwhile, DeFi just keeps plugging along. Of course, crypto tokens are down, but like everything was very clear and it was very easy to see where risk was and key margin call points on things like Maker. So you guys are both definitely right in that space, and that of course is very nicely aligned with what ShapeShift is. It really what our ethos and values is. In terms of, and this might. Feel free to push this question back a little bit if there's more overview, and I see we also have Carlos up as well. But I'm really curious for the community to hear sort of like what when you say this is a protocol, a lending protocol that's more geared towards long tail assets, what about Fringe makes it more specific to long tails as opposed to sort of a generalized and permissionless protocol for lending that could just apply to sort of like any old ERC20?
Yes. There are a number of things. We've got some engineering, as I mentioned, and we've got some lending parameter considerations that come into play, and also just the model that we're using in terms of single capital pools, which create a greater depth of capital. So let me just touch on one or two of those. In terms of engineering, we have a couple of things that are quite important, which is limits on the lending, the debt limits against each asset. Because there is so much liquidity for any given token out there, for any given long tail token, it's quite important that we don't overextend loans or debt against that asset, because in worst case events such as liquidations and market downturns, liquidators will want to liquidate positions that might become below the minimum collateralization level, and for them to then dispose of those assets or the collateral that they win in the liquidation, they'll need to have sufficient liquidity in the marketplace. So that's why we impose those kinds of limits. And we've spent quite a bit of time engineering and modeling the lending parameters that we apply to the long tail assets so that it's quite tailored. And we've written a few pieces on that. And I might just ask this bit, Alex, just to very briefly describe in a sentence or two really what that's about, because he's certainly largely the brains behind that, and it's worthwhile hearing, I think.
Yeah, so there's like basically two primary risks, two primary risks associated with listing small market cap assets. The first is that the price is easier to manipulate, and so therefore attacks can potentially be carried out involving manipulating the price of collateral assets in order to steal funds from the lending platform. And the second is that it's harder to liquidate loans that are collateralized in those collateral assets because there's less liquidity there's less like market liquidity available that you can sell the collateral into in order to liquidate the loan. And so basically we have created algorithms for calculating the debt limits that take into account both of those limitations and basically ensure that all of the loans that are taken out against a certain collateral asset can always be liquidated given the current market liquidity available. And there's like quite a conservative assumption, but I think that like it's hard to make or to use any other assumptions because just because of the volatility and the unpredictability of the liquidity of these collateral assets, I think that it's necessary to make those types of conservative assumptions. And so that ensures that we can always liquidate all the loans against a given collateral asset, and therefore giving lenders peace of mind that they will always be able to get their capital back in the case that the loans need to be liquidated, which allows for lower interest rates because lenders are more willing to provide capital. And in order to prevent price manipulation attacks, we have basically figured out an algorithm for calculating the profitability of a price manipulation attack. And so we ensure that the profitability is always below zero based on the cost of manipulating the price and the potential benefits that the attacker could derive from carrying out that attack. And we do that by ensuring that the debt limit is below a certain point, which is necessary, or below the point that would be necessary for the attacker to find the attack to be profitable. And so those are the two primary ways we enable small or like low market cap collateral assets to be listed, and that other lending platforms, as far as we are aware, do not implement. And so therefore they have to like fracture liquidity in order to list low market cap collateral assets because they don't really know how to quantify the risks associated with it. And so therefore they don't want to expose all lenders to those risks because they're like less predictable and verifiable.
Fascinating. So in terms of price manipulation attacks, are you guys using like a Uniswap v3 TWAP sort of feed, or do you have Chainlink feeds in there?
Currently, go on.
Go ahead, Alex. I think you might have one or two bits of information that'll make that more interesting than I might be able to.
Well, basically, currently we're using Chainlink, but we plan on using V3. We're looking into V2 as well, but V2 it actually is possible to use in a secure manner, believe it or not, despite all the hacks that have occurred due to projects using the V2 price feed. But it's just extremely expensive. Like it costs about $100K per year just to maintain the price feed and keep it up to date, due to the amount of updates that are necessary in order to make it secure. I can go into that if you're interested, but basically we're looking into integrating V3, and V3 is very good for price manipulation costs because it's quite expensive to manipulate the V3 oracle, but it has the same limitations as V2 does in terms of liquidity, because you can't, if there's only like 100K of liquidity in a V3 market, then you can really only liquidate about 100K of loans in it. And yeah, so we can apply both of those algorithms to V3, and I'm currently working on calculating debt limits for V3 based markets. But yeah, we use Chainlink for all of our current markets.
Awesome. And just to clarify that first point you made, or the first method by which you sort of account for these challenges that arise when you have longer tail assets that are less liquid, is it accurate to say that you have done a bit of a trade-off where you require more collateral to be added as a way to compensate for the fact that maybe you have wider price swings due to like low liquidity here, and compensate for the relatively higher risk of price manipulation? Is it that more collateral is required in Fringe, maybe relative to other protocols that are just using or are you dealing with like super high liquidity tokens?
Well, actually, yeah, that was the third mechanism that I forgot to mention, which is like our LVRs. So yeah, we do set, I suppose, relatively high LVRs compared to, sorry, relatively low LVRs relative to other lending platforms. And yeah, that is based off a strategy, like an algorithm that we implement that involves backtesting the price movements of that collateral asset over the last like year or so, and basically determining like what the largest drawdown was over a several-hour period of that asset, and then using that, or basically setting the LVR such that if that largest drawdown occurred again, that we would still be over collateralized. We wouldn't become insolvent. And so, yeah, I suppose it's like it seems to be more conservative than most other lending platforms, but at the same time, I don't really understand like the philosophy behind those lending platforms' choice of LVRs. A lot of the times it just seems quite arbitrary, although some of them employ less arbitrary means, of course. But yeah, that kind of seems like a very like a kind of the only logical way of going about it, because otherwise it's the case that in the past there have been drawdowns in those assets that could have resulted in the lending platform becoming under collateralized if those drawdowns occurred again, and that just seems like quite a risky bet to make that they won't occur. So yeah.
Cool. Yeah. Thanks for the answer. That makes sense. So kind of opening it up to other facets of this, Carlos, I know you've been working on Fringe for a while, and oh, by the way, guys, Carlos has a sweet podcast. Sorry, the name escapes me right now, Carlos, but you should share a link on the stage because it always insightful stuff on your podcast.
Right on. It's the Decor podcast. I actually stopped hosting it like 2 weeks ago, but the episode featuring Kent here is pretty good. So yeah, check it out. And also, hi Kent.
Hey, how's it going, man?
All good. Like you know how it is on the internet. Like your internet shall always break when you have a presentation you're really been looking forward to. But
It's a hard and fast rule of like working in tech, isn't it?
Yeah. So yeah, I mean, I've been a part of Fringe ever since we started our attempt to build this primary lending platform this time around. There was a previous platform design that was scrapped, but like we've been working on this for a while now, and it's just been really nice to see the platform come into operations, and especially nowadays that we get to come to these DAO meetings and pitch to you guys, talk about how, of course, your community can now take up loans using your Fox tokens as a collateral, but also just the DAO itself. It was really cool to hear about how you guys managed your loans with Rari. So, and props for the huge engagement that you guys have.
Yeah, thanks. It's a very timely thing to ponder. As you might have gleaned from what I was talking about earlier, or ever tuned into the our Treasury Management Committee chats, we devoted a lot of time and effort to thinking about the status of our Rari loans. Of course, borrowing is completely turned off right now, making that aspect of the platform sort of moot right now. So it's really cool to see like new alternatives emerging, particularly those that maybe are more tailored towards the needs of longer tail assets, of which Fox is definitely one. So if you look at the page, I just checked it out. Fox is actually listed on Fringe. Is this is on the live version?
Correct.
Yeah, we added it yesterday.
Very cool. Well, it's great to see Fox up on a new platform, and I appreciate you guys adding that. That's awesome.
Yeah, and we have also, I mean, we're also always open to finding other ways to collaborate, also with ShapeShift as a platform. But we listed Fox as a collateral asset yesterday, and if Brian or Alex could remind me what the current LVR is, but I reckon it was a bit higher than we anticipated. So it's just good to see like that you guys can be aware of it and come into the platform and look into it, and hopefully get a loan if you decide to do so.
And that's fringe.fi is the URL, correct?
Or app.fringe.fi.
Okay.
Yes. Yeah.
And how long have you guys been live?
We have been live for just over a month.
Excellent. With respect to the code, Is any of the code sort of forked over from previous implementations or pre-existing implementations of lending platforms, or is this sort of built from the ground up with this unique use case in mind?
The good thing is we do employ a lot of existing code. I'll say a lot. Core components of Compound. So there are solid and well-proven components of that we wanted to employ here because that is really core to the platform that we're building, which is, at the end of the day, we want the engineering to be solid, and we want to bolt on a couple of things and certain philosophies and ways of thinking that best support the long tail assets. So it's not anything super innovative in terms of everything being built from the ground up. So we think that is very much a core part of our value proposition, which is solid, core, reliable code.
Yeah, code stability and security is always a good thing. If any Foxes out there want to evaluate the audits that have been done around Fringe, where can they go to for that? Is that just on your site there?
Right, fringe.fi, and it's on the front page there. I think even on the you don't even have to scroll down. HashX is one of the auditors there that we publish.
Perfect. In terms of kind of like just like the platforms that you're on, so this is just currently mainnet. Or do you have any plans to bounce over to or expand to a roll-up, or are you just sort of thinking, well, at least for this initial phase, the first X amount of months, mainnet suffices for what you guys are trying to do?
We are currently in testing on other L1s and L2s. That's definitely within our sights, and we're exploring ways to do cross-chain collateralization. But, we're treading carefully there because, as this weekend demonstrates, bridging and interchain ops is something to be very wary of and to ensure that you get it right. So in terms of supporting other chains, we're intending initially to do a lift and shift so that we can support lending on those other chains. Yes.
Yeah, lately it seems like a lot of these DeFi bridges are built of like balsa wood or toothpicks or something. It's been ugly.
We don't want to expose ourselves to too many of the risks there. Even on other chains, there are collateral assets which are wrapped and from other chains, and they're wrapped and manifest on those other L1s and L2s. And ultimately, the operators on those other chains are, by and large, dependent on the security of those bridges. So there are many considerations with regard to multi-chain operations.
Yeah, absolutely. Just a new consideration that you don't have to deal with on mainnet. A question from the stage chat here. PTT is wondering, great question. What lessons did your team learn from the Rari loan hack or / exploit?
I think Alex can talk fairly authoritatively on that one.
Yeah, so basically, that hack resulted from a reentrancy from a reentrant smart contract call that was caused by them supporting WETH as a capital asset. And so basically, currently, we only support USDC as a capital asset, and so therefore, it's not possible for any reentrancy attacks to occur, even if we were using the exact same code as Rari, which we are not. And so basically, since we only support USDC as a capital asset, it's not possible for any other smart contracts, any malicious smart contracts to be called in the process of anyone interacting with the Fringe platform, and therefore it's not possible for any reentrancy attacks to occur. But yeah, basically we've paid very close attention to all of these reentrancy attacks and have ensured that our code is not vulnerable in the same way as these platforms are. But I think that the issue with like Rari and a lot of other permissionless lending platforms is that they allow for ERC20s to be listed on their lending platforms that haven't been like carefully verified and haven't been carefully vetted to ensure that they don't open up any of these reentrancy attacks or these types of composability attacks that are they're often like quite hard to foresee unless you do a lot of analysis. And so the primary way in which Fringe has a competitive advantage over them in that regard is that we only have a single lending pool, and so therefore we can like very carefully review every asset that is listed to our lending pool before it is listed, and ensure there's no like negative interactions like those reentrancy attacks. And the reason why we can do that is because we have ways of verifying the economic security of each of our collateral assets that we list, and so therefore we don't need to kind of make the trade-off of splitting up our liquidity to allow people to like make their own decisions as to what collateral assets they want to be exposed to due to not really knowing what the actual security is of those collateral assets, but rather we actually can verify that the collateral assets are economically secure when we list them, and therefore everyone can be exposed to all the collateral assets because we ensure that there's no way that they could be used to steal funds from the platform. So I think that is like the primary way that we are resistant to those types of reentrancy attacks that Rari recently experienced.
Awesome. Thanks for that thorough explanation. Anybody that wants, if you didn't quite catch that, as always, we record these on Twitch. That'll be live on Twitch shortly if you want to replay any of this again. Let's see. I do want to start to wrap things up here with Fringe because we still have Pasta Ghost after this. I want to make sure he has enough time to chat. But let's see. DeFi boy, the stage chat seems very enamored with your voice. I agree. It's a nice combination of like a slight baritone and the Queen's English, which to our American ears sounds quite sophisticated and convincing.
Interesting, because a number of people have said that I have a good face for radio.
Video killed the radio star, as the old song sang, right?
Yeah.
Let's see here. Any other questions? That's true. I do have a lot of song references, huh? So, okay, just kind of pulling back and thinking again about the nexus of ShapeShift and Fringe. Obviously, there's a very direct sort of overlap now that Fringe or Fox is listed on this. So if you guys are interested in lending or borrowing with Fox, check it out. I imagine liquidity in those pools will improve over time as Fringe gets the word out about what they're doing. In terms of other, possible collaborations, there's always, and this is one thing, we've talked about before in a more one-on-one setting, but like, ShapeShift is always looking for potential DeFi products to integrate directly into its platform, with the value prop being that we get more eyeballs and users for you, and you in turn perhaps might give a rev share. That's kind of one of our core business models. This is certainly something that we always keep in mind for relevant DeFi protocols, and something that I probably would we as a community would be interested in talking about as you guys begin to get more users, because ShapeShift is really designed to be a frictionless and sort of like nice one-stop shop for all your interfacing with the DeFi world. And another interesting thing to consider, and we don't have enough time to go down this rabbit hole, but like, do you guys have a token?
We do. We have the FRIN token, FRIN.
FRIN, okay. The reason I ask is we also have the ShapeShift DAO has a sub-DAO called VFox, which is authorized to make strategic allocations into other projects, strictly tokenized projects. So that's always I always mention that as a possible avenue for collaboration. Let's just wrap it up really quickly here with one final question from PTT. Is there any concern that Fringe could grow to a point where you can't vet every token as thoroughly as you are now? Does adding more tokens increase risk, or perhaps it's the case that since everything is over collateralized, even if a token completely shits the bed, it doesn't really, you're accounting for that because things are over collateralized?
There's two answers to that question, or there's two parts to that question. To the second part, yes, it's over collateralized, so it offers that safety, if you like. And for the first part, our intention is to list several hundred tokens, but there will be careful consideration in listing each token because we have modeling that we undertake and we're further and further automating that. But at the end of the day, it is very much we whitelist those tokens and we vet them according to quite a number of criteria. So it's quite important for the safety and long-term viability of the platform that the good scrutiny is applied before listing any token.
I think also as we add more collateral assets, we'll have we'll presumably be growing, and so therefore we'll have more resources to allocate to constant monitoring and to monitoring upfront before listing any of these tokens. So it might even become easier to actually to audit and to vet these tokens before we list them, due to just having more resources, really. And yeah, we'll always have we'll always have monitoring occurring in real time as well, so that if anything looks suspicious or begins to look worrying with regards to any of the listed tokens, then we can then potentially stop new loans from occurring against those collateral assets and various other protective measures like that.
Awesome. Well, guys, really appreciate the concise answers and the overview. Also very cool to see Fox listed on your protocol. If anybody wants to check this out, again, that's app.fringe.fi. And the three of you, it's great to have you here in the community and in the Discord. Welcome to the community. Always feel free to let us know what's going on, the latest or greatest, or just hang out. We have a public tokenomics channel you can always jump into and geek out with us. Yeah, Carlos, yeah, absolutely. Any parting thoughts here?
I just want to say thanks, Kent. Yeah, it's been an absolute pleasure, and it's really great to have the opportunity to talk to your community, because that's, we're in the business of engaging with these kinds of communities. It's what we're about. We live and breathe it, and we're really happy to be part of the, partnering with you on this. And I've always been a fan of ShapeShift, even through its various changes in life. And the guys involved there right from the get-go have really impressed me. And and I think this has been just such a wonderful opportunity. Thank you.
Thank you.
Yeah, and I also wanted to say for all the guys that are just in the community and in the channel commenting and all that, it's always great to get your feedback. There's nothing worse than indifference. So if you feel strongly either way about anything you see about Fringe or in our platform in general, be sure to let us know, because we take note of all the feedback. I don't know if we have time for this, Kent, or if this happened at all when my internet was done for a minute there, but did we talk about what's next in the Fringe roadmap when it comes to the rest of the ecosystem with staking and USB?
Yeah, well, Kent mentioned he wished to wrap up. So what we might do is just in one sentence mention we have a roadmap. We're including things such as I mentioned before, cross-chain integration, fixed interest, lending and borrowing. We think that will be quite important because it opens up an entire new market to actors who wish to have certain ability to manage their costs for lending and manage their more predictable returns for borrowing. And they're important parts of really what we see is a really healthy set of opportunities in the DeFi marketplace.
Great. And yeah, even though we're wrapping up now, if you guys also want to support or post more of that related content about your roadmap, you can do so in our general channel, get more eyes on that. And as you evolve and progress, definitely keep us apprised here in the Discord.
Thank you. Yes, we will.
All right. Well, thanks again, guys, for jumping in. Also, and dealing with the time zone differences, and we're really excited to see what you guys do next too. And thanks again for listening ShapeShift.
Hey, our pleasure. See you. Thank you very much. Bye.
Good day.
Thanks, guys.
Thank you very much.
See you.
GM. All right, cool. Well, we have a little time left here for Pasta Ghost. Pasta Ghost, thanks for your patience. Get you up on stage here. How you doing today?
Doing all right. How you doing?
Good.
Can you hear me?
What's that?
Can you hear me all right?
Yes.
Okay, great. Yeah, I've had some audio trouble with this PC recently.
Yeah, I'm just your voice is slightly low. So this is a cool hack in Discord. I don't know if everybody's aware, but you can adjust everybody's specific user volume. So if anybody's ever a little low, you can just increase their volume. Or sometimes somebody's like super loud, and you can just right click on their avatar, and you can tweak their voice. So yeah, we're going to shift gears here, kind of return to a theme I alluded to earlier when we were talking about the runway and loans. Around the discussions we've had recently about budget and runway, there's been some interesting insights. Neverwas had a really cool post that I believe inspired what we're going to talk about now in terms of thinking beyond just strictly sort of runway for runway's sake and being creative with things and thinking outside the box. And again, Neverwas, what you were saying about not resting our laurels, 100%. And Pasta Ghost has done some really interesting analysis, some incisive analysis, and some deep thought around exactly this sort of thing. So yeah, I'll just hand it over to you.
Okay, great. Thanks, Kent. I do have some numbers to share. So is it best to share screen via Zoom, or can I do that here?
Let's see. You could definitely, if you're screen sharing, you're going to want to use Zoom. Alternatively, like the quick and easy way to do it is just like post the link in the stage chat and people can follow along. But there is a Zoom link created right now if you want to jump into Zoom.
Okay, sounds great. I'll do both. So this is the spreadsheet that I'm going to be referencing. And then I'll go ahead and share screen. So I'll show a couple of other things on. Okay. Everyone's got that pulled up already. I'll give just a couple more seconds, either join Zoom or pull up the spreadsheet. So this came out of a bit of thought that I did to Neverwas presentation at the weekly governance call, I think 2 weeks ago, where he discussed some of the content from his proposal in the forum, draft proposal to austerity options. I'm not sure if everyone's had an opportunity to take a look at that, but I do suggest taking a look. There's some interesting content. He makes a number of points, but one of them stuck out to me, and that's that in light of the recent external financial situation, we've had to make fairly extensive budget cuts across all departments. That's to be expected, and to some degree, reducing USDC spend is the only viable option that we've got on the table. Something that hadn't been discussed much prior to Neverwas, as far as I'm aware, was consideration for the impact in terms of capacity to fulfill our mission as a DAO. In light of the budget cuts that were being that were proposed by each of the work streams independently. And I think you brought up a good point. Cutting is only effective to a point. Beyond that point, we run the risk of hindering ourselves to such a degree that we can't make necessary progress during the time that we're trying to stay alive during the bear market, and that the effects of the decisions made now might be deferred by a few months. So I took a look at what the actual impact of, I wanted to take a look at what the actual impact was of some of the resourcing decisions that have been made. Obviously, having been a member of the engineering workstream, I've got most context on the engineering workstream. I'm not sure whether this applies or to what extent it applies on other workstreams. So I only did this analysis for the engineering workstream. But I do think that it might be useful to make the same sorts of considerations for the other work streams, maybe aggregate the data, and we might be able to, in doing so, model more effectively or estimate the results of DAO-wide strategies that are along the lines of what I took a look at in the spreadsheet here. So you can see a number of people are looking at the spreadsheet simultaneously, and we've got a few people on Zoom. So I will go through and explain what I've written. So the original engineering budget in the box labeled Strategy 1. With the budget cuts that have been made in work streams outside the DAO. Work streams outside the engineering work stream across the DAO. Should the engineering work stream have taken no strategy, the monthly USDC spend would have been 154,750, and this is just for, I'm just considering fixed salary costs for the engineering work stream. So I took this information. Well, here you'll see a couple of other things that are calculated for each of these strategies. So one is capacity; it's the number of engineers that are available. Saving percentage is calculated relative to strategy number one. So obviously, this percentage here is 0. And capital efficiency is a parameter that is also calculated relative to strategy number 1. But I calculated that as the number of engineers available or engineering capacity available per USDC's token spent by the workstream. So I took the monthly USDC spend, I plugged that information into Kent's runway projection spreadsheet, and determined that determined what the impact of the runway was for each of these strategies. The runway end date, should the engineering workstream have taken no action, made no budget cuts, would be May 13th, 2003, given a monthly USDC spend of 154,750. The strategy that's been proposed, there's currently in effect, at least partially anyway, is cutting 5 of 9 engineers from the engineering workstream. So that does save a substantial amount of money from the monthly USDC. So this is advantageous to the DAO in terms of reducing the USDC spend is clear. Under this strategy, the DAO runway end date is extended to July 15th from May 13th. That comes at some cost, however. The engineering capacity, the number of engineers available relative to strategy number 1, where nothing is done, is 44%. The capital efficiency, so the number, the capacity available per USDC token spent, is better than the original engineering budgets, but only by 5%. And so what this shows is that reducing the number of engineers to 4 from 9, to 4 from 9, is really only buying the DAO. What is this? Really only buying the DAO. I took a look at whether or not there were other strategies that would allow us to make better use of the USDC spend through some creative options other than just cutting. One strategy that had been discussed at the engineering workstream was each of the engineers, each of the original 9 engineers, one is elsewhere and so will no longer be participating. So 8 of the original 9 engineers taking some percentage of their compensation. I found that if all engineers take 25% of their compensation, and that can be boosted or non-boosted funds, then the DAO runway end date is extended to June 15th, 2023. So under this strategy, 8 engineers are retained in engineering in exchange for a 4-week shortening of the DAO runway. So making a comparison between strategy 2 and strategy 3, what it shows is that capacity, that being considered the number of engineers available, is reduced by 50% in exchange for 4 extra weeks. 4 extra weeks of the DAO runway over the next. So let me phrase that more accurately. There is an option available that would allow us to retain 8 instead of 4 engineers, and it would cost us 4 weeks. 4 weeks time, 4 weeks runway for the DAO timeline is stated now in comparison to strategy. Taking a measure of capital efficiency here, again calculated as the number of engineers available per USDC token spent, it's 28% more efficient than the strategy where only 4 are retained. I don't have this listed here, but I ran the numbers for a couple of other strategies. Strategies where 4 of the 8 engineers take 50% of their compensation in Fox. The 4 that I have, at least 4 of those engineers have committed to doing that. If that happens, the runway end date is extended to June 28th, 2023, June 15th. which is only a 17-day difference between the strategy that retains 8 engineers and the strategy that retains 4. If everyone in engineering takes 50% compensation in Fox, then the runway difference between the strategy that retains 4 engineers and the strategy that retains 8 is 3 days. So this is just one particular creative solutions might be able to help us better optimize how it is we're spending USDC from the treasury. And I think this kind of analysis is applicable DAO-wide. Now, it sounds great to just say, take a significant percentage of your compensation in Fox, and we can dramatically reduce the USDC spend while retaining, the ability to produce. Of course, that can't come for free, right? So what am I trying to say? In having DAO contributors take significant portions of their compensation in Fox, there must be some consideration for the impact that selling that Fox on the open market has on the price of Fox. So I took a look at that also. In this case, where all 8 engineers take 25% of their compensation in Fox, the monthly Fox spend is $34,437. And then I calculated what the price impact of Fox would be. I actually redid those numbers today. So that's $480,457. If that were all sold on one day, and all of that Fox was exchanged in the Fox liquidity, given the current pool depth, that would result in a price decrease of negative 0.79%. So that would drive the price down from its price as of 4 o'clock today, which was 8.21 cents. It would drive the price down by 0.07 of a cent, from 8.21 cents to 8.14 cents. If you multiply that price difference by the fully diluted market cap for Fox, that is $700,000, just over, almost exactly $1,000 of market value swing. However, if you take a look at the price history of Fox, you'll see that the volatility of Fox is sufficiently high that a price movement of 0.79% is well within the noise floor that's introduced by ordinary market activity, entirely out of our control. So while the total market value swing does seem like a lot of money, the ordinary market value swing, across timescales of a few hours during a day, is typically substantially higher than what might be introduced by the worst case scenario, where all of that Fox is sold in a single transaction on one day via the Uniswap ETH Fox liquidity.
So you're arguing that concerns about just people, basically the impact of selling Fox on the open market in cases where contributors taking more Fox, we're not choosing the time locked option, are somewhat overblown based on the current liquidity in Uniswap.
That's right.
Okay.
Furthermore, I would say that given that the price of Fox is so low, I can't say that it's likely. Contributors are incentivized not to sell the Fox at these prices if they don't have to. It's exceedingly likely that the Fox price will be substantially higher than it is now upon emergence from the bear market. And so that provides a strong incentive for contributors paid in Fox to retain as much of that Fox as they're.
Yeah, this is it's interesting to look at this stuff. I think one interesting takeaway is sort of pulling back from the engineering workstream specific analysis that you've done here very, very meticulously. I think it really shows the power in general of being able to encourage people to take Fox. This is exactly why we developed boosted Fox as a way to incent long-term holding of Fox and people taking that instead of USDC. On the runway projection spreadsheet that I maintain, I have a column called boosted Fox that I currently have at 5%. So that basically assumes that of the monthly budget in USDC, or that would otherwise be paid in USDC, like, okay, how many people are taking boosted Fox? Historically, the first few months, it's been around that figure. One interesting thing you guys can do if you want to play around with different assumptions is say, okay, what would that look like if people were taking maybe 20% in boosted Fox? Maybe that's a likely scenario if the market starts to come back a little bit, or if, maybe if it doesn't, but there's a sense that, okay, for more austerity, we don't want to be cutting USDC or cutting roles. We would want to do that collectively as a community, or workstream leaders might want to do that. So that's another way to sort of play around with things. Also, I think it's interesting, kind of an interesting takeaway for other workstream leaders, just to note, like, this is a potential tool that the DAO has and the workstream leaders have in their budgeting belt, or their budgeting toolbox to use. So yeah, some interesting takeaways here, both with respect to the engineering budget, but also the DAO as a whole.
Hey, sorry guys, I jumped up. I just wanted to say that one of the other points that when I was making with my original post is basically a spend is still a spend. So whether you're swapping that asset for a different asset, in this case swapping it for Fox versus USDC, it's still a spend of the treasury asset. It's still an expense that the DAO has to reconcile at some point, whether it's deferred for 6 months, 3 months, 12 months. It's still a reconcilable expense that has to be done. So I mean, while it definitely can help, and it has the benefits of not using the USD spend, stablecoin USDC spend, it still does act as a spend, and I'm not too big on the boosted Fox thing, because we don't know what those repercussions are going to be down the road. I mean, it can work out very well, but it can also work out in ways that we can't really account for yet, because we don't know what the market's going to do in 6 months. We don't know what the market's going to do in 9 months or 12 months. And having that additional expense on the books for 30%, 10%, 20% is still a liability for the DAO itself. So, I mean, I would say that, while these things can help, I think that we need to ensure that we are, looking at all the different sides of these things. Thanks.
Thanks for jumping in, Never Was. Let's see. And I realize we're 10 minutes over here, but we're in the midst of a good discussion. So, I mean, let's keep rocking out if you guys are still down for more chatting. And the Stage Chat DeFi Cafe says the most important note, the output of individual contributors is not fungible. This analysis is predicated on that assumption. So, yeah, there is sort of a human element here to consider. It is, I guess that's a good point in terms of, like, you can't distill everything necessarily down to just the numbers that are on a spreadsheet.
Absolutely. Yeah, I don't disagree with the statement that the output is not fungible. That's certainly true. People have their individual differences in output that's time varying. Also, their individual differences in core competencies, right? Different people are more familiar with different parts of the stack, more proficient in others, and so on. No, I'm not relying on that assumption entirely. But the assumption that I am relying on is the average difference in individual output is not so large so as to invalidate the trend in general.
Sorry, could you say that one more time?
I'm saying that the assumption I'm relying on, the differences in individual output on average between the individual contributors is not so large that the trend I'm identifying is invalidated.
Okay.
It is true that, yeah.
Cool. So let's see. Yeah, there's interesting sort of discussion here regarding just Fox versus USDC in general. I think, one interesting thing, going back to what Never was saying about the expense, kind of having a liability, like to pay this out. It is the most important thing in terms of strictly, and I am admittedly being a little bit myopic with my focus when I say this, but in terms of preserving and maintaining and lengthening our USDC runway, that the Fox, using boosted Fox does help directly with that, regardless of what the Fox is, the price of Fox is in the future, and us owing more Fox. It does serve to lengthen the runway. So I think it does play an important role in terms of that. There's a lot of different facets to this conversation. Pasta Ghost if anybody wants to kind of fork your, let's say a workstream leader wanted to like sort of copy your spreadsheet and make it more specific to their own work stream, is it just a matter perhaps of kind of entering in their own respective contributors into this, and then you have the budgets or the strategies already set up here?
That's right. The DAO runway end date doesn't calculate automatically. So I've taken the monthly USDC spend that's calculated automatically, plug that into your runway projection spreadsheet in the appropriate for the appropriate line item in like the, let's say, the September budget. Taking the total spend, plug that back into the runway projection, onto the runway projection sheet, right? Dragged down all of the corresponding monthly budget listing, and then I can like do like a linear interpolation thing and figure out which day at the budget.
Yeah. So if anybody is doing the same approach, definitely reference my runway projection spreadsheet for the latest data for the current data, or forward looking, say for September or whatever. Let's see. So yeah, I think there's definitely some interesting like nuance here. Ron's wondering if you could assign weights to contributions.
Yes, that would work.
Yeah, you could do that. One of the cool things is we're really sort of making this up as we go along. Like, and again, it really speaks to the unique abilities we have because we have our own token. Like, you just couldn't do this with a traditional company. I mean, I guess you could ask people to take sweat equity instead of salary, and there's that too. But I think there's a lot of advantages that come with doing this on a nice, transparent blockchain where everything is codified. We are at 5:15. Pasta Ghost, if you wanted, I guess if people want to continue to engage you on this topic, what would be a good way to do that? You could always jump into tokenomics, or you could, just, or however else you want to continue to discuss this.
Yeah, if anybody wants to discuss this further, feel free to DM me at any. I have open DMs turned off, so you'll have to send me a friend request first. But I've got Discord installed on my phone, and I'm usually in front of my computer. So one way or the other, I can respond to you quickly. And would love to continue this discussion further if anybody has anything related to this they'd like to talk about. Excellent.
Well, thanks for taking the time to work up this analysis and for presenting on it.
Absolutely. Thanks for having me.
Cool. Have a good one. Well, that was a busy one, guys. It's 5:15 here in Denver, so we're going to wrap it up. Hope everybody has an excellent rest of your week. This will be on Twitch if you ever want to listen or have an instant replay on this. And it's always fun to hang out with you guys. Really appreciate you. I just got to say, as a way of wrapping up, I'm more bullish on ShapeShift than I've ever been. Listening to like Michael talk about Fox Chain today, like, damn, dude, this stuff is powerful. I think we're going to survive this bear market and make it out stronger than ever and really change the fucking world. So that said, everybody have a fantastic week. Thanks for joining. Take care.